Hello everyone, welcome to another episode of Do Academy. Warren Buffett is one of the most successful investors of all time as he is known for his investment vision and strategies. He bucked the mainstream investing trends and amassed a personal fortune of over $60 billion. He famously transformed a struggling textile mill into a holding company with well-known brands, a market cap of nearly $700 billion, and a Class A stock trading at more than $460,000 per share. His investment prowess earned him the nickname the Oracle of Omaha as he lives and works in Omaha, Nebraska. So, what exactly are the investment strategies he used to achieve such a feat? Ready your notepads and jot away as we explore the various strategies that are commonly fancied by Warren Buffett himself. In 1962, Buffett noticed that Berkshire's price tends to rise whenever mill closures are announced, and he thought there was a value gap between the prevailing price of $7 to $8 and the book value of the stock at $20 to $21. To explain, book value means the value of a business according to its financial statements. Market value, in turn, refers to the value of a company according to the stock market. Therefore, when a company's market value exceeds its book value, it indicates that investors believe the company has good prospects for future growth. However, due to Berkshire's low stock price, patrician CEO and chairman Seabury Stanton would often use the liquidated proceeds from the mill closures to buy back its stock. Noticing this, Buffett contacted Stanton and offered to sell more than 2 million Berkshire stocks he controlled on behalf of his partner investors. The two agreed on a price of $11.50 per share, but when it arrived, Buffett discovered that Stanton's official offer was only $11.38 of what the stock was trading at the time. This angered the Oracle of Omaha, who loathes being taken advantage of in a business transaction. Buffett proceeded to reject the proposed tender offer and began buying more Berkshire stock with the intention of joining the board to eventually depose Stanton. In 1965, Buffett succeeded but soon realized that this was a costly feud simply because mills were no longer a viable business. In 1985, Buffett decided to shut down Berkshire's textile operations because the troubled business required substantial investment but produced relatively weak returns compared to the other growing businesses at the time. In a 2010 interview, the Oracle of Omaha admitted that the Berkshire Hathaway was the dumbest stock he'd ever bought. He then made another bold claim, saying that Berkshire will double in size and will now return its focus on business insurance rather than textiles. Since taking office, Buffett quickly demonstrated his famous ability to adapt by installing new management and ensuring that Berkshire will no longer allocate funds to looms and mills. By the late 1960s, Buffett started using Berkshire's assets to buy cheap but promising stocks, and the modern-day Berkshire Hathaway was born. The key strategy is value investing. In value investing, popularized by Benjamin Graham, investors are able to focus on a stock's intrinsic value rather than focusing on technical indicators. Value investors will actively seek out the undervalued stocks because they believe that the market is overreacting to both good and bad news, resulting in stock price movements that are not in line with the company's long-term fundamentals. And such overreaction presents an opportunity to profit by buying stocks at a discount. The more years of good return on equity, the better. Buffett prefers companies that have consistently delivered a positive and acceptable ROE over the years rather than companies that deliver steady returns in the short term. Yes, Buffett prefers companies with low debt or strong shareholders' equity. This would mean that the company is able to generate enough cash flow to cover its liabilities without relying on debt to keep operations afloat. Buffett examines companies' profit margins over several years to discount short-term trends, specifically the erratic price movements that last less than 3 weeks. If a company's management is good at increasing profit margins, it would indicate that the management is good at controlling operating costs. Buffett considers companies that produce products that are often unique and hard to replace. For instance, if a company can refine a desired grade of oil that could potentially gain a competitive advantage, then it might be an investment to watch out for. This is the core of value investing. Value investors look for companies that have good fundamentals but are trading at a lower price than they should be. The greater the discount, the bigger the profit. It's just that simple. In 1959, Buffett met his lifelong friend and business partner, Charlie Munger, in what proved to be a twist of fate for the Oracle of Omaha. Munger is aware that Buffett makes money with his value investing strategy, but he believes and advises the latter that he could have made more money if he had spent more time in investing in great companies at reasonable prices instead of abysmal companies at cheap prices. In 1963, Warren Buffett bought a large chunk of American Express stock after the salad oil scandal, and value investing was applied once again. You can't create another Amex. I can create another shoe store or other business publication with hundreds of billions of dollars. But I can't instill in people what they think of Amex, cited by Buffett. This is because Amex introduces different premium discount rates to encourage card holders to keep using their cards. Sales numbers are bound to increase with recurring customers. In 1963, Amex was embroiled in a scandal that originated with a commodities trader, Tino De Angelis. De Angelis, the founder of Allied Crude Vegetable Oil Company, discovered that banks would make loans against the company's stocks of soybean oil or salad oil. De Angelis used loans from a number of banks, including Amex, to buy soybean oil futures contracts to increase soybeans oil prices. This increases the value of Allied's soybean oil inventories, enabling it to profit from the futures contracts. His plans soon came to an end when authorities discovered that the barrels he was shipping were mostly water. De Angelis served years in prison and filed for personal bankruptcy, leaving Amex to foot the bill for bad loans, causing its market value to plummet. When Buffett saw the news, he took the opportunity to buy 5% of Amex for approximately $20 million. American Express's stock price gradually began to rise after the scandal subsided, making Buffett and his investors millions. The investment in Amex is nearly identical to some of his other famous investments as well. Shortly after the Amex incident, Buffett began buying stocks centered on individual companies' control over consumers. He started viewing bad publicity as a positive if the company itself looks good on paper. In 2020, American Express Company became Berkshire's largest stock holding. Now we own 20% of American Express, cited by Buffett during the 2022 annual Berkshire Hathaway shareholders meeting. That happens to have worked out extremely well. If they overpaid for the stocks and all that, it doesn't solve every problem, but it's a wonderful thing if you've got an asset you like and they take your ownership interest up. Although his investment style has evolved over the years, the Oracle of Omaha figured that the best investments often come from great companies that are underestimated by the market. Amex helped him realize that Munger's advice was right and that he could apply it to any great company in the stock market. Would you agree? Be sure to like, share, and follow for more actionable investment insights now.